Hello. Welcome to our new series of FR in 50 pages. So basically, these are actually just 40 pages. Entire FR, all Indias will be covered. So starting with our first India, that is India's one presentation of financial statements. Easiest India's, nothing to worry about. So basically, it says what are your financial statements? What does financial statements include? So first of all, your financial statements include your balance sheet, your statement of P&L, and that is your OCI, that is your other comprehensive income. Then third is your statement of changes in equity. Next is your statement of cash flow, your notes to accounts, any comparative information of prior period, and seventh is your balance sheet at the beginning of the preceding period. That means current year. Then there is the preceding year and the balance sheet at the beginning. So basically, you are making three balance sheet. That is your closing balance sheet, your opening balance sheet of current year. That is nothing but closing balance sheet of previous year, and they're also saying balance sheet at the beginning of the preceding period. That means the opening balance sheet of the preceding year. Okay, now they have defined what is a current asset, what is a current liability. So for current asset, if any of the four have been satisfied, it becomes a current asset. That is, if it is expected to be sold, if it is expected to be sold or consumed in a normal operating cycle. A lot of you have the notion that if it is done within 12 months, only then no. If the operating cycle is, say, for example, of 18 months, then in such a case, if it is expected to be sold or consumed in within the 18 months, then it will be considered as a current asset. Your other condition is if it is expected to be realized in 12 months. Okay, so if your operating cycle is 6 months, even then you will consider 12 months also, you will get the limit. Next is it is held for trading in ordinary course. That means it is meant for buy and sell. And last is your cash and cash equivalence. So cash and cash equivalence is of course your current assets. Now what is non-current assets? All other assets. All assets which are not current assets become your non-current assets. So we have covered current assets, we've covered non-current assets. Next is for current liability. Current liability also has very similar. That is, if any of the four have been satisfied. That is, any of the four have been satisfied. So if it is expected to be settled in your normal operating cycle. Next, if it is due to be settled in 12 months after the reporting period. If it is held for trading in ordinary course. And last is does not have had unconditional right to defer settlement for 12 months. That means you do not have an option. You do not have an unconditional. That means without any condition, you cannot defer this payment. Only in such a case will this be considered as a current liability. And non-current liabilities, all other liabilities become your non-current liabilities. Any liability which is not a current liability becomes your non-current liability. So if you say current asset and current liability have three things in common, that is your first point, second point, and third point. That is your operating cycle, second is your 12 month, and third is trading in ordinary course of business. If these three, fourth is the only difference, that is in asset it is cash and cash equivalents, and in liabilities, in current liabilities, it does not have an unconditional right to defer settlement. If they have an unconditional right to defer the settlement for the next 12 months, it becomes a current liability. Okay. Next is when it comes to breach of long-term loan. So in cases when a long-term loan is breached, when a long-term loan is breached and you get a grace period. So say for example, your loan was due today. The bank gives you grace period. Ki, don't worry, we will give you 3 months grace period. So because today on balance sheet date, I have already defaulted and they've given me a grace period of how much? They've given me a grace period of only 3 months. So because this grace period is less than 12 months, because this grace period is less than 12 months, in such a case, it will become a current liability. However, if this grace period that they give me is more than 12 months, say for example, 15 months. So now ask a question, do I have to pay this liability within the next 12 months? Your answer is no. Then in such a case, it becomes your non-current liability. Okay, so this period is from the end of the reporting period. Now there are some general features of your financial statement. So that is it presentation of true and fair view. It is made on the assumption of going concern. That is assume that the business will continue forever. Next is your accrual basis of accounting. Accrual basis of accounting means whatever you have earned, whatever you have accrued, that will be accounted. Next is your materiality. Then consistency and comparative information. Comparative information means prior period. Consistency means your accounting policies and procedures have been applied consistently throughout the period through different items. And with this, we have finished your IND AS 1, that is presentation of financial statements. I will see you in the next IND AS.